Good morning, ladies and gentlemen. Today we're going to be talking about, has the market double topped, or are we forming a bull flag and going to continue higher? As a friendly reminder, tomorrow we have ADP non-farm payrolls, so they're expecting at 230,000. Last time it came out at 278,000, so a decrease in the rate of increase, but still a rate of increase of jobs, more jobs creation, more employment, and then challenger job cuts coming in as well. They're expecting for July to come in at 80,000, so we have to see how that all plays out. Initial jobless claims are expected to tick up, but the average is expected to tick down. So again, jobless claims are when people are going to seek work that are not basically employed right now. So if you have more people coming into the same workforce, but the total amount of people looking for jobs goes up because you have more people entering the workforce, that can also cause unemployment to go up, but also the amount of job openings to stay basically where they are at. So it's kind of thinking of pouring water into a pot, but the pot can get pretty big. We also have services PMI coming out, which is expected to basically be the same like last month. But quickly just jumping to the ADP non-farm payrolls, if we look where this has actually been trending, we went from 296 to 278, so about a 20 to $30,000 decrease in the amount of jobs opened. But again, that can mean that the job market is still staying hot. People are finding still jobs. There's still open jobs on the market, so we could expect maybe like a 250,000 number or 240. I still think it comes in a little bit better than the market's expecting, just because it's a significant jump. As you can see, they're expecting 148, 170. It just blew them out of the water. So I usually look at what was historically and the ranges that it changed, and then we go from there. And then February and March, there's also some seasonality that plays into that. So we just have to see how they're going to front load that, or if they're going to see a decreasing in the jobs market, and how the market in general takes that. So if we go to the charts, that's what the most important thing is. We do have this gap below us that we did not actually come to yet, and that price tag where we basically start filling that gap is 141.11. So if you start going below that, then I'm definitely going to be looking for that gap fill and the self-fulfilling rally to go to the downside. Now, that would signify a double topping on the market. This would be a divergence in the market just because you are looking at an area where the MACD has made a lower high while price is making higher high. So we just have to go, and if we go to the MACD, just so I can show you what I'm talking about, as you can see here on the previous peak, our MACD was higher and now we are lower, and we're basically stalling out in this area, as I would call it. And again, the rotation to the downside is easier. You had wicks to the top, you are looking like you want to go lower, and you have some stocks that are indicating that possibly the lower side is potential. However, you could also be basically flagging out here, which means sideways consolidation. We push up, flag out, and then we push up again to then complete that larger A to B pattern that we talked about on the weekend. So just a friendly reminder of what that is. We had our A to B, B to C leg, which projected up to the 466 level, which would signify basically all-time highs on the market. And I think if we get one meaningful ass push and hold it, then I do think a lot of the bears that have still been there, we have that $1 trillion short, they're still there. We could see them capitulate out. However, if we see 441.1110, let's say, get printed, I think it self-manifests and we come down to retest at least the 438.14 level. So again, going to be on the lookout for that, guys, and we have to see how all that plays out. Now, some of the stocks I quickly just want to go over. We got Apple. Apple today actually started to come back and fill this gap here. So again, is that significance to what's going to happen with the rest of the market? And with Apple, I'm going to actually go to Lux Algo just to show you guys a couple of things. One, you pound your head into a reversal zone, so that's where you take profit. MACD is looking like it wants to basically roll over, and it started to roll over with the smart money basically curling towards the downside. You actually have a reversal signal here on today's doji candle. So do we see this basically continuation to the downside, and do we find support on this short-term uptrend that we've had? There's two lines. The white is the long-term uptrend Apple has had going back to when it bottomed at the 143 level back in March. It has held this uptrend all the way up here. So do we first have to break this uptrend in order to stop going up, and then afterwards our ascent level is basically going to change, but we're still going to be ascending. We're still going to be bullish until we break this lower trend line here. Then that's when you start getting really bearish on the market. Now you have the potential to do that. If we look at the weekly, we can clearly see the MACD is separated from one another, and your smart money is basically pounding into Apple since that March, or basically this latest push, which was probably around that earnings time frame. So May time frame, they reversed, start being more bullish on Apple. So we have to see how that all plays out. Again, we are filling this gap, and it could as simply be a pullback to the downside, which then we could rip higher on Apple and to new all-time highs, which would be pretty bullish for the market in general. However, I do want to cover two more areas before we get into the debate section of the video. And that would be the Russell. The Russell is below the rotation to the downside. You basically have a double top on the Russell, and an actual double top. The MACD is failing to cross over on the Russell. It's barely holding on that cross. So we haven't seen that, and we are starting to get some early reversal signals here. So if we start rotating and coming back through these price actions, do we just get the flat rotation down? The Russell was the weakest out of all the indexes today. So basically, does ADP non-front payrolls coming bad? Russell comes down lower. And if the Russell comes down lower, it's really going to drive that big head and shoulders pattern that I've been telling you guys about for quite some time. However, we also have to look at carry. And carry, we're going to have to look on the SMA graph, because this is going to be an important level. 40.23 is going to be a pretty important level for KRE, and that's because that is our 50-day moving average. And this is really starting to look like an A to B to B to C leg on the way down to $36.79, which would take it near the lows of the SVB basically crisis and FRC. So again, are we basically starting to point to the downside, or are we basically a busted pattern on the inverted head and shoulders? Right now we're consolidating, so you don't have a definitive break to the downside or definitive break to the upside, but I just simply don't like how we're basically basing out here. If I look for the bullish trend, then basically it'd be looking at a trend line here that got broken, and now you're testing around this area or dancing around the 50-day moving average. You don't necessarily want to be testing, and like I said before, breaking all these levels. You're kind of just floating right around this 40.83. So if you break the lows of today, that's your range. You're probably going to rotate to the downside, breaking the 50-day moving average and rotating basically down lower to that $36 point, which in a whole would take the whole market with us. And we did get Fed minutes today, which we're going to basically dive into right now, guys, and talk about what were in the Fed minutes, kind of give you a big over highlight and where we see the market going from here. So going into the Fed minutes real quick, guys. So first off, we had some participants indicating they favor or could have supported raising target rate 25 basis points, and this was for the June meeting. So what do you think of that?
I did see that. It's pretty much what we saw with the dot plot. Like, there really isn't much of anything. Like, the markets really didn't even move because it was just like, it's what we already saw with the dot plot. Remember, now the Fed is putting out the dot plot when it comes to their FOMC meeting as well. So, yeah. It didn't come as a surprise.
And we get our next dot plot in September. So in the July meeting, we will not receive a dot plot. The next meeting that we receive the dot plot is September, and then I believe December is the following meeting after that we will see. So there's some speculation that if you're going to get the proverbial pause in rates, which these meetings don't necessarily indicate, they kind of indicate more of, we paused to do what they said, really, where they paused to look at more data. And they don't know yet if that good data is good, bad data is bad or good. It really kind of just is up in the air, in my opinion.
Right. And I think that's the reason why we didn't see much movement after the minutes came out. Like, it was 2 o'clock, it was 2:08 when I realized, oh, the minutes came out. And then I look at the market, I'm like, did it come out? And it was just like, there was no movement. There was no movement at all. So, yeah, it is what it is. Now, that's that line. What about the other one? We got Fed minutes. Almost all participants judged it appropriate or acceptable to leave target rate unchanged.
And I love the wording. Yeah. I love the wording where it's almost, so they judged it appropriate, right? So like lawyer weasel words of, well, we didn't want to say we wanted to necessarily hike this meeting, but we agree with the committee's decision.
Well, yeah. Okay. I see what you mean by that. Yeah.
Weasel words.
So, Yeah, and again, this was for June. So again, everything that we read already, everything that we know already from the FOMC meeting to begin with. Next, we got what?
Most favoring an increase noted very tight labor market. So this is talking about the people that wanted or vocalized that they wanted an increase. So they said the labor market stronger than anticipated economical momentum, aka the market. Little evidence of inflation being on a path to return to 2% target over time. And that line is pretty interesting.
That last line, yeah.
So it goes back to what I think Powell, since, correct me if in March, this is where I believe his tune kind of changed of, we're done raising rates because we've stopped it from going up, but now we're going to look to see, before we pause, we need to see evidence, and to them, evidence is 2 months, in my opinion. I think they've said that multiple months is what they have viewed as evidence that inflation is back to going down to 2%. Until then, they're basically going to take these mini stabs of hike, pause, hike, pause, whatever assortment or flavor of that you want, you basically get from that.
I understand that. They're mainly just like, all right, let's just increase a little bit more and then stop. Wait, did it overflow yet? No, okay, let's keep opening up the flood. Stop, overflow. I think that's kind of how they're doing it.
Yeah, they're basically, Powell said he doesn't want to be Volcker. Volcker just kept raising until something broke, then kept going, and then realized something broke. So he's scared of repeating like the 2019 run where they just hiked, paused for a little bit, and then just went right back down to zero. So again, they basically are looking at, okay, let's see how much damage we're doing and just take a moment.
Right. Drip by drip. Essentially, they're dripping.
They're waterboarding the market.
No, not waterboarding. I would say drip, drip, drip. Yeah. Waterboarding is you pour a ton of water onto somebody's face. Oh, it's drip, drip, drip.
Their version.
They're just trying to see like little by little 25. Notice at first it was 75 for like the first 2 months. Then they went to 50 for a while, and then 25, and now they're like 25. Stop. Look around. We're still good. Everybody still has both legs and both arms. All right, keep going. Right?
It's like playing Russian roulette.
I wouldn't even say that. I think it's more of just like trying not to overflow the bathtub.
Yeah.
Right.
Not repeat Volcker.
Right. All right.
But then
next we have Fed staff saw a mild recession as likely to start later this year, same as in May minutes. And about that, so this morning I did a live stream on Rumble. So if you guys want to check that out, I am live streaming on Rumble. Though I think I made a mistake. I think I put it to YouTube as well.
You did.
My bad. I did.
Yeah.
Dang it! Oh well,
yeah.
Whatever. Did you get the notification?
Yeah, that's how I know.
Dang it! All right. Well, sorry about that. It was supposed to be Rumble only. I'll fix that for tomorrow. But regardless, in my live stream, I was watching Bloomberg, and there was one guy that said, recessions it's most likely going to be next year, most likely.
And again,
I'm just like, okay, that kind of makes sense.
Then their forecasting a recession has never been accurate in the sense of no one says recession is going to happen this quarter and it happens this quarter. It usually kind of rolls around after you kind of have a black swan event, because that's what usually scares everyone into it. And right now the market's no fear. And speaking of no fear, our lovely friend, the Fear and Greed Index, pounding 80, previous close 79. So no, the bulls are not getting shaken out of this market, and they just continue to push this thing higher and higher.
Here's the thing also, when I was watching the Bloomberg thing, there was just one problem with their whole entire thesis. They're not taking into account the student loan repayments starting in September.
Well, the lag of monetary policy, a lot of stuff. You have bad things on the horizon. You have the entire bond market upside down, and you're basically telling regional banks, you're on your own. You're not getting any help.
So I think that's something that they're not taking into account. And when you see it, a recession may start later this year, and then you're like, well, the fact of the matter is that we may get, the whole student loan thing. We have no idea how that's going to impact it. We really, really don't.
Yep.
All right.
And then they talked about upside risk. Like, they always say that upside risk, the inflation outlook, possible inflation expectations might become unanchored, remaining key to policy outlook. So that's just talking about their forecasting of the expected inflation. And I think they've been I think they've been pretty good about where they see it going, because they're just basically waiting for the data. They're looking in hindsight, which is bad. You don't necessarily want to be looking in hindsight when you break something, but they're not going ballistic in one way or another.
Right.
Then they had a few market participants noted potential for upward pressure of money market rates as Treasury increased bill insurance, which might lead to lower usage.
Issuance.
Yeah, issuance, which might lead to lower use of RRP facility, which is the reverse repo. Yeah. So it's just, it's like four pools of water, right? So you got the Treasury account, the Fed's balance sheet, the reverse repo, and repo. So it's basically just a shuffling game between all of them. Money flows out of this one, goes to this one. The money flows out of that one, goes into this one. It's just a massive three-card Monty shuffling game.
Right.
So,
right.
But
all I know is that with this whole minute stuff, nothing really happened.
They didn't give you anything new. They just basically But here's the thing: is the market listening to what they said for the past two meetings, or is the market kind of just off on its little tangent, as I would say?
I guess we'll see what we get tomorrow as well as Friday when it comes to the numbers, right?
Yeah, and we can actually go to the Fed CME tool to kind of understand if they actually priced anything in. So again, they've been having this rate basically at the hike in July. I don't think anyone's debating that. I think they're pretty much saying a 25 basis point hike in July. That's pretty much not off the table. But if we go to December, that's where it gets interesting. So your current is 50 to 525. So you got a 42% chance of one more hike, and then a 30% chance of basically a second hike in December.
Right, two hikes.
So again, they're not. I wouldn't say this is priced in because it's a 30 and 42% chance. It doesn't. To me, this should be a higher number, or basically guaranteed. You shouldn't have cuts because the Fed have basically told you 20% of people think that they're not going to raise rates between now and December, after they've explicitly told you that rates are going higher for longer, and no cuts.
So about that, I also saw on the Wall Street Journal, on Bloomberg while I was watching it this morning, I also saw from the Wall Street Journal, they put up a thing on the screen saying that they believe a rate cut. Listen to this. This is insane. They believe a rate cut will happen if jobs numbers get to 100,000 or less. Listen to this. And the month-over-month CPI figure is less than 0.2.
So that makes no sense, because if we go to the jobs numbers, right? So they're expecting jobs numbers. So let's pull this up. So
I know
they're expecting non-farm payrolls.
Yep.
So let's see. So you're expecting something that hasn't happened since
less than 100,000. Yeah.
Okay.
February.
So you're expecting, this doesn't count. I say this is a blip, right? So let's go back to where we were sub 100K for an extreme long period of time as an exercise, and you got it here.
I would say that one.
Yeah, but it wasn't. It was for a month, and then it jumped right back up. So I want to see
for an extended amount of time.
Yeah, because the Fed's not if the Fed won't take one data point, what do you think they're going to take it on jobs?
Yeah, that's true. Right there. I would say right there. Yeah.
Around here. Okay.
69, 80, 96. Yeah.
So let's see 2011, 2012. Let's do a little exercise, and let's pull up the market. I'll go to a weekly basis to basically see what was happening during that time, right? Let's explore. Oh yeah, the debt ceiling and the near default. We were coming out of the near default, and the market was pretty going up. But then look, April of 2012, 20 basically to May, which if we look here, April, May, right? That decrease here. Oh, we got a nice, let's see, approximately 10% correction in the market. So jobs going down in the same time, 10%. Okay. So, but let's go to a place where it was consistently, let's see, 2010, 2011.
I mean, I would argue if you, okay, fine.
So 2010, 2011, dips, jumps, but really it's when you get to these levels, going back to basically the great financial crisis of when you started. And if you look how fast this actually accelerates, you start having below trend growth right here. So like, we're struggling to get, you got 2006, 200, like where we're at now, right?
Yep.
And then look how fast it degrades from April of 2007 to August. So about 5 months, right?
Right.
Complete degradation and then an absolutely just collapse the subsequent time frame. But if you look at what happened during that time frame when it started to degrade in 08, so all-time bull market, you start degrading in 07, you have the drop in March into May, you really degraded and then you sent through. So you don't want jobs to go away like that. That's not something history teaches us that's not good for the market. So
no, I agree. It's just that's what the Wall Street Journal mentions, and then it's just like it has to be less than 100K, and the month-over-month CPI has to be less than 0.2.
And is that core, or are they saying
core? Yes, core.
Okay,
core has to be less than 0.2.
So let's do the same exercise with core. So less than 0.2, you're going back to 2019. So you basically, they're hiding the meaning behind it. They basically say the economy has to fall off a cliff because the only way you get back there is inflation to be at target with jobs below growth, which means recession.
And that's going to be interesting because that's tomorrow when we're going to get the ADP numbers. And that's not really going to tell us much. I have seen ADPs come out with one thing and then the real numbers come out to be a completely different thing.
Well, what's your take? Let me
means.
pull it up for you. What does let's see this week. What does so we got minutes, ADP. So they're expecting if I expand this, you can clearly see you had 296, 278. They're expecting 230. I was saying 250. That's what I was thinking.
250, 255 maybe.
So I don't think that it hits their number.
When is this coming out?
Tomorrow.
When is this?
Tomorrow 8:30.
8:30. Is it 8:30 scroll?
When you guys are actually 8:15. It says here.
Yeah, it's 8:15. That's right.
Okay, 8:15. Sorry. So you get 8:15. By the time you guys see this video, it would already be out. But again, I don't see the job market just rolling over. I don't know. In my work, we struggle to find people the same way probably in yours, where there's not people lining up the door for a job.
Not really.
So, but there's crap ton of job openings.
Yes.
So again, I don't expect that to degrade anytime soon, just because the job market, it takes months to cool, which we've shown in this video. You don't get the month to month, fall to negative, right? So they're expecting by year's end rate cuts. That means something has to tremendously break between them.
And I will be covering that tomorrow, guys, only on Rumble, and this time I'll only do it on Rumble, I promise. So I will cover that when it comes out at 8:15. So, I think that's where pretty much going to end it here. Hopefully everybody liked, subscribe, comment. Really does help here on YouTube as well as Rumble, everybody. So with that said, peace out, and we'll see you next time.